This is the weekly economic and market report for the week ending September 9th and looking forward to September 12th, 2022. And per usual, talk about my personal sentiment right now, which is that I'm 80% bullish now. I'm up 15%. Wow. 20% bearish and 0% neutral. And I'm currently investing that way and trading that way. For the midterm, looking out further, 30% bullish, 70% bearish. And what that means is I'll start looking at things like bear put back spreads and things of that sort, straddles, as I start to think things are topping out. If the strategy falls, that we see some type of, as David Hunter put, a melt up, then I'm still protecting my backside on that 20% using bull call back spreads. So I can kind of go either way with the investment. And again, I have these videos up if you want to learn. It's not investment advice. It's just what I personally do, and it might help some other people. And that's what this channel is really all about, is I think you have to be your own fiduciary and learn about all the tools that are available to you as far as investing goes. So the investor sentiment, as I predicted last week, which comes out on Wednesday evening, was 18.1% bullish, 53.3% bearish, and 28.7% neutral. Now, it may have gotten lower at some point, but that's what I like to see when I'm investing. When everybody's on one side of the ship, I want to be on a different side. But that's my contrarian way of investing. Now, it's played out fairly well this week as the markets have started to take off a little bit. But again, I still have one foot on land and one in the boat that's going to take me across the sea if things continue to go up, but I want to protect my backside, and that's why I do back spreads and straddles. So let's look at the 10-year Treasury. Now, this is one of the things that's worrying to me, and I talk about this every week, but this has gotten up over 3.31%. If this continues up, then I will pretty quickly become bearish. I think this is temporary. I'm hopeful that it'll start to decline. I don't think you get a melt up or you get a huge run without the 10-year Treasury note going down. And, David Hunter didn't expect, if you haven't watched that video, it's one of the most popular ones I've had for a new channel. I'll take it. But I don't think he had expected to get over 3.2%, but here we sit at 3.31%. So I've kind of got my eye on it as, it will lead what the Fed does. So that's one of the things that I'm watching. Another thing is the dollar. So we can see here that we have some negative divergence here on the RSI. These are relative strength index. They're just indicators that help me. Okay, where is the dollar going? Now, expectation is that it'll continue to go down. It actually, overnight, it went down to, I think, 108.3 or something like that. What was it about? Yeah, $108.33. And this goes back to the Milkshake Theory again, another episode that I have out there, understanding the Milkshake Theory. And if the dollar continues to gain strength, what problems that causes for the globe is something to keep an eye on. The other thing that I'm also watching here, which is kind of a lead into one of the figures that's coming out this next week, that I know the Fed's going to have to look at it, even though they say they watch PCE, but is the Consumer Price Index. And, you know, crude oil actually went down as low as almost a little under $81. The WTI West Texas Intermediate crude, and as you can tell, we're definitely in a downtrend here. After it peaked out at about $119 back, quite a while ago in March. And has went down a little bit, came back up. Now we're on our way down, and the expectation is that will continue to go down, and that will affect the Consumer Price Index. That will be coming out on September 13th, which I'll talk about here a little bit more. I did find another piece of data I thought was interesting. It kind of tells how weak things are getting in the market, and that was the United States mortgage applications. And, we're down 3.7%, down 0.8%. These are all numbers that are leading to weakening of our economy. You think of all the things that a house requires. You have to have the mortgage, you have the refrigerators, you've got, there's just a lot of economic activity around home and home selling. And so it really is an important indicator of what's happening in the marketplace. So as rates have gone up, as the Fed has tightened, or lifted the Fed funds rate, these are the figures you keep an eye on, and that's why the 10-year Treasury becomes important also. Personal consumption expenditure is won't come out until September 30th of this month, and that's supposedly what Chairman Powell of the Federal Reserve looks at to decide what they're going to do with their federal funds rate and their quantitative tightening and all of those types of things. And so we don't get that till the 30th, but next week we get the CPI. Now, the expectation right now, as you can see here, the consensus expectation is 8.1%. If it comes below that, even if it goes down to 8.1%, I think it'll move the markets somewhat in a positive direction. But if it gets below 8%, something in the sevens, I think you're going to see the markets explode. And it might. We just looked at WTI Crude. Some of the inflationary pressures are, at least in the short term, going to provide some relief. And this feeds into David Hunter's Milkshake theory that he has. This is one of the things that has to happen, and my opinion is that the CPI is going to have to provide some relief in order for the Fed to pause. And I will be having a video I've been working on for the Federal Reserve. Are they going to raise rates? Are they going to pivot? And what are all the or pause? And what are all the variables that could potentially move them one way or another, as far as whether they continue to raise the Fed funds rate. Now, the expectation right now is that here in September that they're going to raise them 0.75%, and I do believe that the CPI will have a large influence of whether that's 0.75 point, half a point. They're gonna raise it. I'm not under any delusion whatsoever that the Fed is not going to raise rates. I don't like some of the comments that come out. Kashkari is one of the people that has come out and basically said, we were glad to see the stock market go down 1,000 points. Who is this guy? I mean, seriously? You guys caused this mess. The Federal Reserve did, and it's amazing to me that they're so out of touch with, the average folk, I guess. A GP, as we like to call them, the general public. And so, I don't understand the Fed and some of its thinking, but, that's that we have it. They're controlling it. They're moving things around. They're changing the dials on things. And to be honest with you, with lagging measures, what could go wrong? Everything. And so far has. And it's going to get uglier. But that's for a future episode. So looking to the U.S. calendar here, we have the core inflation coming out as the CPI and the core CPI. We got producer price index will come out on the next week on the 14th, and then retail sales numbers. All these things will Michigan consumer sentiment. It'll be a pretty big week of reporting for the Fed. But let's be honest with this thing is all about the Fed. And something that if you study Austrian economics, that you'll understand that there are, and I did also an episode on this, is on tampering. They're just tampering with the economy. They're over controlling things. And meanwhile, we have Uncle Joe out there who is just spending away, looking for new ways to spend money and, do those types of things. So you got one side with the Fed trying to control inflation, and then you got the government creating inflation. It is mind-boggling, I guess would be the word that I would use. So this week I'm hopeful to get I will get the Federal Reserve episode out. So look for that. I will also be doing an episode on Peter Schiff. I got a number of notes on it, and so that's what I have upcoming. I had hoped, and maybe I will be able to this weekend put together the Federal Reserve piece. I don't think it'll be a terribly long one, but just the factors, the variables that they're going to have to look at, or that may be affecting what their decision is and how much they raise, and some of the flows of things that will affect their decision. So anyway, that's my commentary for this week. And remember, and please remember, there's always a better way. And especially with the Fed, there's a better way of doing this. We've just been doing this since 1913 with the Fed, and we need to find a new way. So remember, there's always a better way.